With rising inflation, interest rates, and the dawn of a recession looming large, a lot of people are currently panicking about what this means for their investments, careers, and financial future. However, has everyone lost sight of the bigger picture? Contrary to popular belief, economic downturns are nothing but a golden opportunity to build wealth. We dare say it is a once-in-a-decade opportunity to get rich. Still skeptical? Well, walk with us here for a second. Have you ever seen a rich person truly complain about the recession? That's because when the economy goes down, their earnings go up. As a matter of fact, Warren Buffett addresses this himself.
Who's winning in this economy right now?
The rich. Guys like me. We have gone from having 93 billion, top 400, in 1982 to having 2.4 trillion, 25 for 1.
Just think about the economy as a game where the rich hold all the cheat codes. There is a really interesting chart that we'd like to show you. But first, eliminate the fear of recessions and the crash of stocks by listening to these wise words from the Oracle of Omaha.
Well, I don't think there's a particular risk in the economy over time. We will have recessions from time to time. And we had a real doozy in the fall of 2008 and early 2009. And that has had more consequences than other recessions have had post-World War II. But the American economy is a wonderful machine. It really works. It's worked since 1776, and it'll continue to work. But we will continue to have ups and downs.
The moral lesson here is simple. No matter how bad things look, never forget that recessions are a mere characteristic of economic cycles, and when handled perfectly, could provide extraordinary opportunities that could change one's financial future and life for the better. Take a look at this chart of the S&P 500's returns in bull and bear markets. Did you notice any patterns? Every crash in the stock market was followed by an even stronger recovery. Believe me when I tell you that there are a lot of smart investment decisions that could help you build wealth, even in the difficult economic climate we currently find ourselves in. This perspective is also echoed by the Oracle of Omaha, who famously once said that bad news is music to the ears of an investor.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of...
On that note, let's take a closer look at some of the things that are predicted to unfold in the next 3 to 6 months, along with the promising opportunities at hand. You might want to pay close attention, because the things you hear next are all you will need to strategically position yourself for the creation of lasting wealth. Ready? Let's begin by unraveling the mysteries behind the economic situation that you will likely be navigating in 2024. Starting off, it's pivotal to acknowledge that during economic downturns, unemployment becomes the order of the day. But let's assume significant layoffs don't happen. Other cons, like huge wage cuts and a decrease in the value of different assets like stocks, energy, food, and other services, become rampant. To make things worse, these effects have a knack for echoing around the globe while carrying damaging effects. Furthermore, in a recession, corporate earnings usually shrink. Companies reveal diminished revenues, and they offer cautious forecasts that mirror the increased risks associated with economic downturns. We'd hate to be the bearer of bad news, but there's a high chance that the United States, and even the world, might enter another economic recession next year. Up until now, extreme weather events have been irregular and confined to specific regions. But there's a possibility that they could become synchronized. Intense droughts and heat waves have the potential to significantly disrupt production, causing food shortages, stressing global supply chains, and elevating household expenses. In regions experiencing food scarcity, there's a risk of widespread migration, or, in extreme cases, conflict with profound political consequences that may extend beyond borders. And how about the tension between China and Taiwan? This could heavily affect the semiconductor industry. Its ripple effect will be crazy. We're also seeing the conflict between Israel and Hamas is showing no signs of slowing down. While there's a low chance of it becoming a regional conflict, the global impact of such a thing happening will be immense. Recently, numerous companies have been revising their forecasts downward, anticipating slow or potentially negative growth. This marks the most elevated level of recessionary risk that we have seen in a decade. As a result, layoffs will become more common. Cash-strapped customers are cutting back on their spending due to reduced incomes, and this makes companies streamline their expenses. Unfortunately, it's the employees who usually bear the brunt of these cost-cutting measures. Firms want to save money by reducing their wage bill. Make no mistake, companies are already implementing mass layoffs. According to Bank of America, the United States is poised to lose approximately 175,000 jobs per month. Skeptical? Let's paint the bigger picture here by looking at just 4 companies out of the hundreds that are planning to downsize. Let's start with Nokia, the Finnish telecom company. It's letting go up to 14,000 employees as part of its cost-cutting measures. It impacts a workforce of 86,000 globally. Paramount Global is set to close Showtime Sports Division at the end of the year, and this will also result in unspecified layoffs. Additionally, Rolls-Royce is trimming 2,500 jobs worldwide to address years of underperformance, affecting approximately 6% of the engine maker's total workforce. And let's not forgetting the fact that Stack Overflow has laid off 28% of its staff, merely a year after doubling its workforce. You're probably wondering how all this bad news translates into golden opportunities for investors and the average Joe to take advantage of, aren't you? Well, let's begin with real estate. While these markets tend to vary significantly by region, and some areas may continue to flourish in any economic situation, a decline in nationwide housing is quite rare. Over the past 6 decades, there have been only a few times where home prices suffered from crazy drops that were over 15%. Presently, experts on Wall Street are in agreement that national housing prices might see a 10% decrease. In a more pessimistic scenario, a 10 to 25% decline is conceivable should interest rates continue to rise. It's crucial to highlight that real estate markets vary significantly by location. Analytical insights indicate that particularly vulnerable markets, certain areas like Florida, Arizona, Idaho, and Southern California, could experience declines up to 30% from their peak. This downturn might endure for about 2 years before stabilizing. In the larger picture, these shifts might not greatly affect homeowners, especially those with fixed-rate mortgages intending to stay put for the next 5 to 10 years. But for those who are considering property investment or new purchases, this downturn could present appealing opportunities, a topic we'll delve into shortly. For now, let's talk about the second point, which concerns cash. Historically, cash has been perceived as a less than ideal asset, given its tendency to lose value against inflation. However, when other asset classes face declining values, cash emerges as a safe haven for preserving wealth. Having a dedicated emergency fund becomes especially valuable in situations where you might need to draw from your assets, especially in the event of a layoff. Ideally, an emergency fund should encompass a minimum of 3 to 6 months' worth of your living expenses, encompassing rent, utilities, food, and medications. It's also worth noting that, as of 2018, cash stood out as the best performing asset class. People who have saved in high-yield savings accounts outperform the market. Right now, cash is currently gaining recognition in investment portfolios, with fund managers holding the highest levels of cash since 2001. Even Citigroup is suggesting cash can serve as a hedge for investors during the recession. Speaking of hedges during recessions, gold is a good pick that is recession-proof. Historically, during recessions, the value of gold has at times seen an increase. For instance, in 1973 and 1974, when the stock market declined by 17.37% and 29.72% respectively, the price of gold rose by 73.49% and 67.4% in those same years. Similar patterns can be observed in 2002 and 2008. While one can argue that this trend isn't universal, it has been proven true in many stock market downturns over the years. Gold can be considered a sensible asset during times of economic turmoil, and this is echoed by Joseph Sherman, the CEO of Gold Alliance, a precious metal supplier, who once said, "During recessions, when paper assets like stocks and bonds are depressed, companies' employees feel the pressure, and they tend to run to the safety of gold," which explains its surge. Think of it as a bet against the dollar. During recessions, when confidence in the Federal Reserve is low, people often turn to non-FIAT companies, not backed by what they perceive as struggling central bankers and governments. And it's not a bad practice. That said, just note that it's not exactly the best move you can make when you are looking at things from a long-term perspective. But don't take my word for it. Here's what the Oracle of Omaha has to say regarding gold.
And instead you use the $10,000 to buy gold. Now for your $10,000, you would have been able to buy about 300 ounces of gold. And while the businesses were reinvesting in more plants and new inventions came along, you would go down every year look into your safe deposit box, and you'd have your 300 ounces of gold, and you could look at it, and you could fondle it, and you could, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything.
This leads us to the third point, stocks. It's no longer news that the three major stock market indices have experienced declines ranging from approximately 15 to 30%. And to make things worse, according to analysis from JP Morgan and Goldman Sachs, there is a possibility of another 20% drop from the current levels. However, historical data since 1946 indicates that the average bear market decline has been close to 30%, with the most severe case occurring in 2009 when the S&P 500 plummeted by a staggering 54% from its peak. When we factor in the onset of a recession, bear markets tend to fare even worse, experiencing an average decline of 34%. Historically, the absolute bottom is often reached when investors capitulate, signaling that it could be an opportune moment to start anticipating a recovery and a subsequent market rebound. Now, with all of that out of the way, let's explore why this impending recession might present a golden opportunity to make you rich and build generational wealth. First and foremost, the competition will be reduced. As stated earlier, larger companies tend to play it safe and either cut back on expenses or face closure when the going gets tough in challenging economic times. However, one man's poison could be another man's favorite meal. This could open up opportunities for smaller, more agile businesses to step in and make a name for themselves. Research indicates that companies maintaining their advertising efforts during recessions can enhance their value and achieve positive growth even after economic downturns conclude. This underscores the potential for smaller companies to thrive when their larger counterparts are scaling back. Secondly, everything becomes more affordable. While economic downturns are often seen in a negative light, it's essential to change this perspective. A declining market translates to more affordable assets. For instance, whenever you see a stock decline by 50%, it basically means you could buy it for 50% cheaper. For those in a position to invest, that's a crazy discount. Remember when Warren Buffett said he loved it when the price of stocks dropped? Well, that's because he knows it's a golden opportunity to make more money. Just take a look at this bold statement regarding investing during economic recessions.
I can't predict recessions. If you guaranteed me there would be a recession next year, I would be buying and selling the same securities I'm buying and selling today.
Number 3, never forget that after every bear market, a bull market follows. A cyclic pattern that is supported by historical data. During recessions, the S&P 500, for example, has historically declined by an average of around 30%, with a median drop of 25%. However, after these stocks hit their lowest point, the subsequent year often sees an average return of 42%, and within 2 years, the market typically rebounds by an average of 60%. This means that investing during a market decline can fetch you a lot more money than simply withdrawing and waiting. Number 4, the natural selection in the market. Comparatively, the peak of a market cycle mirrors the unforgiving jungle. While you have the largest and most established companies resembling the lions that are at the top of the food chain, smaller firms, they feel like the gazelles that are just waiting to be hunted. However, just like forest fires, economic downturns do have this knack of changing the status quo and taking out companies that can no longer sustain themselves. A new market will be opened when the jungle comes to life again. Newer, smaller businesses will have the opportunity to shine as well. Finally, you have to be proactive. This may sound counterintuitive, but recessions are usually only officially confirmed after months of the onset. Sometimes, it's even called out at the tail end. During the Great Recession of 2007 and 2008, the recession itself wasn't declared until December of 2008, just a few months before it came to a halt. The preceding recession in 2001 began in February, yet its official recognition didn't come until October of the same year. This delayed confirmation underscores the challenge of precisely timing market moves and why you shouldn't be waiting for the recession to end. With everything that has been said and done, here's how you can take advantage of a recession, starting with number 1, which is holding cash. Although statistics support the idea that it is better to invest your money right away, keeping a cash reserve can provide security and the freedom to take advantage of investment possibilities if they present themselves. It is smart to hold some cash in your portfolio, and a sweet spot for this is around 15 to 20%. This brings us to the second point, which is cutting down on your expenses. When the economy starts to be shaky, scaling back your expenses will do you a lot of good. Frugal decisions like maintaining a lean budget, tracking your expenses, and taking active measures to prevent you from spending too much are always the right choices. From today on, think of a good and sustainable strategy that will manage your finances just in case your income reduces in the face of economic challenges, or worse, if you're the victim of a massive layoff. This will give you the safety net that you can rely on. Speaking of massive layoffs, though, you might want to secure your job. Selling your investments to make ends meet after a layoff often leads to financial setbacks, and that's one of the last things you'd want in an economic recession. Let's be real for a second. Companies only let people go when they're considered expendable. Enhance your skills, learn new ones, and show your employees that you offer value to the company. That will give you a lot of leverage when the workforce is being trimmed. Number 4 on the list is one of the best decisions you can make: diversifying your investments. Guys, this is crucial for risk management. Include a mix of assets such as large cap stocks, international stocks, real estate, or passive income generating investments. We've got a lot of amazing videos on businesses that not only run themselves, but will fetch you a lot of money over time. The thing is, the more diversified your portfolio is, the more resilient it will be in case certain assets underperform. And finally, always think about the long term when you invest. Remember that clip of Warren Buffett saying he'd continue his usual investment strategies even if an economic recession happened today. Be like him and keep investing as you normally would, as if nothing strange were occurring. Regularly investing in markets or dollar cost averaging has traditionally been a successful tactic. Moreover, in the long term, the market has consistently recovered in all historical instances. Never forget this golden advice from Warren Buffett on long-term investing.
But you shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them. And you're not going to pick the bottom and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more.
To address his idea of long-term investing, did you know that if you had invested $1,000 in TSLA stock 10 years ago, today that investment would be $116,000. That's the amazing effect of long-term investments.